I'm Ozbourne Foreman, and in this video I'm going to be asking your most commonly asked questions. And I'm going to be real with you. The reason I'm doing this is because I've been, as of late, having a really bad creative block. This means I've been unable to think of effective video topics or titles, and it's gone as far as that I just really haven't been able to record. So as a backup, I decided to ask about questions that you should ask me, or a Q&A, and I figured that hopefully would help by the time we can get to the portfolio update and the week will be reset and I'll be fresh again. This is combined with the idea that I'm actually starting to dislike the stock analysis series, although I'll be talking about that at a later point in the future. So the first question I have here is, why are you so bullish on UK stocks? And have you considered investing in European or American stocks? Well, to start, I believe an important thing to mention is understanding. If I grew up in Europe or America, then it's very likely that I would have invested in those domestic stocks. However, since I'm in the UK, my level of understanding is the UK markets. After all, I've grown up here, I know what brands are big and what wouldn't be. For example, if I then looked to America, which many UK citizens do, to invest, I may not necessarily know the brands unless they are of a significantly high market cap. My investment strategy has transitioned. I aim for the more small to mid cap stocks now. Whilst yes, I do have, I believe, 2 large cap stocks, the rest of them are on a much smaller scale. Therefore, it's unlikely that I'm going to know of these US stocks that are of that size, because I don't have the understanding to know what's in that local market. And I don't doubt that there perhaps is more opportunities in the US, and after all, they are seeing fantastic run-ups. I'm just more confident on the UK. And you could say, sure, that is a home bias, and I think that's a fair argument, but I would rather just invest in what I understand. As for being bullish, I believe that the UK economy has been beaten up for quite a while. I think there's a few compounding factors that could certainly bolster it for the future. The likes of Brexit. We've also got the pandemic and subsequent lockdowns that have negatively impacted GDP in the short term. More people are saving money. This could come in quite useful. Furthermore, with the vaccines, I believe, no, I'm not even going to try and spew a figure because I don't know, this is completely off script, but we've got an incredible amount of the population already having their first jab. They're going to need a second jab to have it fully up to scratch, but that'll be a lot more people. Europe, by the looks of it, is trailing behind. Therefore, I think we're going to be travelling, but domestically. Therefore, I feel that this accumulated money that people have saved during the lockdowns is likely just going to be saved up and then spent, meaning that we might see a short-term burst in our GDP. But that's only a short to medium-term reason as to why I'm bullish. I just think over the longer term, the UK certainly has potential to stop being this undervalued market compared to its peers in the US and start to outperform. But I do believe, for the most part, the UK markets have underperformed simply because we're tracking the FTSE 100, a globally diverse indicator that has massive companies that aren't really in sectors of high growth. The next question is from the Discord, and it is there any US stocks that you have an interest in? I'm going to be honest, there actually isn't. I don't follow many US stocks. I've seen a few, the likes of streaming applications or fintech. They interest me a lot. I typically try to look into the US market, see what kind of trends are going on, and then try to replicate that in the UK. But I don't really follow the US markets that much. Definitely not on a day-to-day basis. I might look at the S&P 500, see how it's doing on a weekly basis, but other than that, I don't follow any of the US stocks or have an interest in any of them. Many channels are predicting a crash is coming. What are your thoughts on this, and what do you think they are basing it on? Well, I'm going to assume that from this comment we're going back to the US here, as it does seem like it is in bubble territory. I've not seen any of the videos predicting a crash, but I can tell that we have a lot of, I believe, euphoria. Everyone is greedy right now. Everyone is wanting to buy stocks, and it's really pushing the markets up. Even the likes of Argo Blockchain, which I will be talking about more lately, that's seen fantastic run-ups in the last week, although that's more due to a valuation re-rate rather than the likes of organic growth. If I had to guess, I believe it's because it seems like we're in bubble territory. Interest rates are all-time lows. Therefore, there's less value of storing cash in a bank account, and therefore it seems more likely that these investors are pumping more money into the markets, combined with the Federal Reserve's balance sheet adding further quantitative easing. It does very much seem like we're in bubble territory, but in reality, I think because stocks have this higher value at the moment, with this low interest rate territory, people are just climbing into riskier assets. And for the time being, I think that this bubble has more room to go up, and I don't think we will be seeing a crash. And typically, when a lot of people start to predict a crash, I'm quite contrarian in a way, and I don't really feel it's coming. I don't really believe the hype. If it does happen, I'm prepared. I have cash on the sidelines, and I do think the UK markets do have a sort of disconnect to the euphoria we can see in the US. And I believe that the UK will likely obviously follow, as they say, when the US sneezes, the whole world catches a cold. But I don't think the UK markets will drop by as much. And I mean, even on Thursday, we had seen quite a drop in the markets. My portfolio remained quite resilient. Another question is, what's the day job? And I have mentioned this in the past, but this was a long time ago. Technically though, it's not a day job. I actually was a pub worker, and I mean, I still am, but we're in lockdowns currently, and so I've been furloughed since mid-December. Typically, I would be working at night shifts. I would do something like a 6 or to 12-hour shift on an extreme case, and I'd usually work 3 or 4 days a week, but take more shifts when possible. However, then during the pandemic, I had started the YouTube channel, and it's become a little bit more time consuming, so I do less hours. So I'm not really a full-time worker at the pub, but I pick up shifts where possible, and it usually makes up to the hours. Are you going to be buying more Team 17 on the 8%-ish dip today? And in fact, I've not bought any Team 17 just yet, but likely when this video is uploaded, I will have bought more. I've been depositing cash and I put some in there, and I will hopefully be buying on Friday or today when the video is out, as it is quite a good value, but I have had my priorities elsewhere with the likes of Argo Blockchain. As for reasonings behind the dip, I'm not entirely sure. I believe it is a sector-wide thing. It could also be from the likes of EA acquiring Codemasters and sentiment dropping. But at the same time, people could be taking profit from these stocks and investing elsewhere where they see more favorability. Will I be buying Bitcoin or Riot, which is on Freetrade? Also, will I be buying US stocks, which I've mentioned earlier? So I'm not going to be buying Bitcoin at the moment. I don't see value in the asset itself, at least not in the long term. I don't believe we will adopt this currency like many people believe. Perhaps I'm just not well researched enough, but I feel there's a lot more cons than there are pros to the subject. However, in the short to medium term, I have gained exposure to this, and I did speak about this last week in the portfolio update, but I have bought shares of Argo Blockchain, and I have held the initial position for the last month and a half. I believe gaining exposure to Bitcoin through a cryptocurrency miner is the way forward in my opinion, as it effectively has a lot less risk, and especially with the situation of Argo Blockchain, which is another miner like you had mentioned, Riot, which is one of their competitors. Argo Blockchain is valued at a much lower multiple and therefore has a lot more potential to go up with valuation re-rates. And therefore my exposure to Bitcoin in the short to medium term is with Argo Blockchain. Following on, there is another question, and that is, when will I cash out on Argo Blockchain, or have I already done so? And on this point, I have not cashed out on Argo Blockchain just yet. I believe, and this is off the top of my head, in my Trading 212 general investment account, I hold 1,068 shares. That's seen about a 190% gain since the investment, and I'm going to continue holding for the short term, especially because it was a free ride. All of that money that I had invested on that portfolio were actually free share referrals, and none of that money is my own. Furthermore, in my Freetrade ISA, I believe I have somewhere in the ballpark of a few hundred shares, although I don't know off the top of my head. I plan to continue buying more where I see value, and I'm happy to continue averaging up into the price, because at the current price, which I believe was around 290 pence on close as of Thursday, I still think there's 2 to 3 times, maybe 4 times potential on the shares. But when will I truly cash out, and I have mentioned short to medium term, is when I feel that they've been appropriately valued. Furthermore, as I said, I'm not bullish on long-term Bitcoin. I believe that once Federal easing or Federal Reserve's quantitative easing slows down, interest rates start to rally again, that we will see people move out of these riskier assets and backwards, like going from the riskier assets like crypto and penny stocks into your growth stocks. Those people in growth stocks might move to dividends and so forth, into savings accounts, etc. The idea is that less people will want crypto when there is less incentive for it, and that's where I feel that that's the point where I should sell. And I'm not concerned at what price target Bitcoin hits, but But I do think with the institutional adoption at the moment, that in the short to medium term, they are set for a significant run up. I plan to take as much profits as I can from this, and what I will do is I will build a position in my ISA and then probably just leave a small allocation so that I have a crypto allocation available with a high margin of safety, hopefully, assuming that Argo Blockchain continues to climb. Furthermore, this question also asks if I am still in education, and the answer to that is no. I finished education at the age of 19, I'm 21 by the way, and I had done sixth form. I'd done that after doing my GCSEs, so till the age of 18. I realised at that point that I didn't enjoy reading from textbooks and just regurgitating that knowledge, and I felt that I could apply myself somewhere better, basically. I just didn't enjoy what I did. It might be through fault the subjects and topics I'd done, as I did do the likes of chemistry and biology, and then I was forced to pick business, although I did enjoy that the most. But I think it would have been the subjects, as I just really didn't enjoy them. I decided that I didn't want to follow on, didn't want to go to university. I probably didn't have good enough grades for university anyway, and felt that, and I think in a way it was sort of a blessing, because in hindsight there's no way I would have wanted to take on that debt. No way I would have enjoyed uni during the lockdown, as you have no ability to socialise, and I feel that I can generate an income stream and career and get ahead in those few years, even though I had stayed in education to the age of 19 as much as possible. You will have noticed that from sixth form, what did I do after that? Well, in fact, I went to college and I did plumbing for a year, which might be a bit weird to see, and I'm a fully qualified plumber's mate, but there's not really much of it. I enjoyed it, but I'm a pretty skinny lad. I can't do much heavy lifting. I remember there's this tool, I don't know what it does, it vibrates and it has this chisel kind of thing at the top. I was trying to cut out a piece of the ceiling, and this it's about that big and that way. I was holding it and my whole body was just shaking like a skeleton or something. Skeleton? My whole body was rattling. I just realized, yeah, this probably isn't for me unless I put on some muscle. So then I thought, you know what? I'm just going to get education. I'm going to find a job as soon as possible, which is exactly what I did and how I got into my current bar job. I know I was looking for new job opportunities and the pandemic hit, which at the same time could have been more of a blessing than a curse, as it allowed me to get cracking with the YouTube channel, which has done pretty great so far. So what are your thoughts on index funds as a percentage of the portfolio? I.e., would you recommend the average trader, say, had 50% allocated to index funds? I personally believe this is based on your own risk tolerance. I personally am not that interested in index funds because I believe that with upfront time spent as research into these companies, that you could likely outperform the index funds. However, it also depends on risk tolerance, and I'm very a risky person. I'm happy to take these risks, and so I'm happy to have all of my money in individual stocks, especially such a limited amount. However, for those that aren't as comfortable or doubt or have less time to invest in researching these companies, there is a strategy called core and satellite. The idea is that you have 80 to 90% of your overall portfolio in index funds. That adds your stability, perhaps your global diversification, and then your fund money, or your 10 to 20%, could be invested in individual stocks, which potentially you could certainly bolster up your returns of your portfolio, but I just like to stick with what I've got. No doubt though, if I were perhaps in a different situation where I have a lot more wealth, I might be looking to preserve that capital rather than to rapidly try and grow it as fast as possible, and at that point I may look towards index funds if I no longer want to follow the markets. However, for the time being, I'm invested in absolutely no index funds apart from in my Nest pension, which I believe I'm invested in the Sharia fund. I'm not entirely sure. Should you buy before the ex-dividend date and collect, or wait until after and get the discount on the price? I'm personally not too sure on this one, and it really depends on how you feel on the company. If you believe it's a quality company, then perhaps just buying consistent sums of it would be a good idea. So you get some before the dividend, you get a small dividend payment perhaps, and then you'll get some after as the price moves. And it really depends on how big of a dividend yield this company has, as for the likes of Halma, for example, that have a 0.7% dividend yield, their share price will drop by around 10 pence, which is less than their daily volatility. But if you've got a very volatile stock that pays a large dividend, or if you've got a very low volatility stock that pays a large dividend, I think National Grid would have been a good example, as they used to trade around £9 and pay a 60p dividend. Then I would certainly wait until after the dividend to try and get on that discount. But overall, I would just put consistent sums of money into the position. If you're confident on the stock, then just continue buying. How do you screen for new stocks, and when will you be looking to do reviews of US stocks, as you had said before that it would be early this year. Starting with the latter question, I had in the past wanted to do US stocks for the start of 2021. However, I did change my mind, and I believe that's because I should really focus on UK stocks. I still have a lot to learn, and I realised how under-researched I personally was in the AIMA markets, and I won't even get started with the FTSE main markets because I've barely looked there. So therefore I feel that my attention is best focused in the UK, and that's why I decided not to cover US stocks. Furthermore, I didn't want to diversify the audience of this channel, as you are all subscribed, or a majority I would assume, for the UK stocks, and to then start putting US stocks into the mix. I feel that some people just wouldn't be interested in that, and there's no need to really divide the audience. And how do I screen for new stocks? I don't really have a strategy in place, and it's usually random sampling. I might hear through word of mouth or on the likes of Twitter about a stock. I will then go into that, I'll quickly load it up on Simply Wall Street, quickly check things like the past performance. Is their earnings scaling with revenue? Is their revenue growth quite positive? I'll also look at free cash flow if they are unprofitable. If they have a positive free cash flow but are temporarily unprofitable, then that could also be a good investment case too. Then I immediately check the balance sheet. I look at their short-term assets. I look at how much debt they have. If they have no debt, high amounts of cash, then I will be interested, and that's where I will start to dive into the investor reports, read into them, like the information behind them. But I don't really screen for these stocks. I will usually just search as I find of them. I have tried screening in the past, but I've had little to no success because I'm usually put off by the idea. I've been trying to look for companies between £10 million and 50 million, which is micro cap stocks. Usually they're either really speculative miners or energy companies that I have no interest in. And so this is something I really need to develop myself, because whilst I do believe I have some very high quality stocks, they may have less growth potential, or for instance the like of Argo Blockchain, I picked on that late. I only heard of it because I was told about it in a comment. And so if I'm able to detect these stocks earlier, I could therefore bolster my returns. And so I'm going to try and put more time into screening for new stocks, but at the moment I don't have a defined strategy. So stocks in the pipeline to bolster your portfolio, and covering those stocks portfolios. And yes, I know the UK stocks. So yeah, I do have a few stocks in line to bolster the portfolio. These would be the likes of Best of the Best, which is a gaming company. I say gaming, it's like an online competition company. I did mention that as a stock tip of the week last week. This is around a £200 million market cap company, and I'm very interested in the likes of it. I believe they have little to no debt, high amounts of cash, and excellent revenue growth in the last few years. I was also interested in Frontier Developments, although less so now, as Elite Dangerous I think is a very capable game, very immersive, and has a large audience of players. But I do think that their revenue has been very up and down, and I'm not as confident on it. There are also other companies that I follow, the likes of Gamma Communications, Spirent Communications, but in truth, I don't really have a watch list of stocks. I typically, as I find them, I will then use that to my advantage and take it and just buy then. I'm also interested in the likes of YouGov, a survey type company or a media company, and I think that they have good potential too. And also the likes of Avon Rubber, an industrial company that has military contracts, although lately they've not done so well due to delaying a contract. And I'm also interested in another media company called Future, or FUTR, and they own a various number of websites, also a magazine subscription company. And I think that as a contrarian investor, they have a lot of potential as they milk the rest of the magazines and then transition to an online website IP company. Recently, they've bought the likes of GoCo or Go Compare, and as they build out their websites and can start offering products to customers, I think it has potential, but it is valued at around £2 billion. Another one from the Discord is what tools to use to analyze and carry out your due diligence when researching stocks. And in truth, I use Simply Wall Street, which I think it can be quite basic, but I use that to get the information quickly. If someone says a stock ticker, for instance, let's just say Genodrive GDR, I will quickly look at it. I will look at the past performance, see how they've done, and look at the balance sheet on the health. That takes about a minute in total. It allows me to just quickly filter out stocks that just aren't good. Then if I'm interested more, and there are, for instance, UK FTSE 350 listed company, I'll jump on dividend data. I will then look at the dividend history of the company, see their 10-year CAGR, compound annual growth rate of the dividend, and when they pay. Then, for instance, if it's not a dividend company, it's very likely that there's not much else that software is going to tell me. And that's why I jump into the investor relations, look at the recent financial reports, see what the chairman's statement is on the likes. Also look more into the industry, their competitors, whether they can build a moat in the future or able to have one now. But as a whole, I only really use Simply Wall Street and dividend data. Although I am interested in stock ARB.L, although I think the price is a bit too high for the size of my portfolio currently, but I would love to use that tool in the future when it seems more justifiable. How are things in the UK? Lockdown affecting the jobs, housing market and economy. So in truth, I don't entirely know. Whilst sure, I live in the UK, I live near London, I've not really been seeing much of it, at least firsthand because I've been furloughed. But what it does seem like is that during the peak of the pandemic, a lot of businesses were cost cutting and therefore they were making typically head office people redundant. This means that there's a level of higher skilled workers that were made redundant and they're probably on like 12-month, 24-month, I don't know if you can get that long, redundancy packages, but it also means that there's quite a gap in the markets. Although recently it seems like there's a lot more availability for jobs, at least lower level, but I'm not entirely too sure, to be honest. So I think there, in total in the job market, it seems like lower level, for instance, anything that entry level that you can get into without much qualifications, I think those jobs are still available and they always will be. But these people you have that are of higher skill are unlikely to drop down to that unless urgent. So it seems like they can afford to be a little bit more patient. They may be out of a job and that's where quite the height of our unemployment is from. And then you've got the middle skill tier workers. Perhaps jobs are a bit difficult to find and a few have been made redundant, but as a whole I don't think there's much to it. But then again, I'm only entry level. I don't have qualifications behind me that could say, hey look, you could work as a head of something anywhere, and I just work in a pub. As for the housing market, it seems quite inflated currently. Houses keep continuing to rise, and that's due to a stamp duty holiday, which is usually, I believe, a 5% fee on housing purchases after your first house. And therefore, since that had been suspended for a period of time, I believe it's up until the end of March this year, more people are going out and buying houses as they're trying to get more value for it, and therefore what's happened is there's more demand than there are people selling houses, and that's pushed up house prices. Furthermore, the likes of flats people living in lockdowns have realised flats just really aren't for them, there's not enough space, and they want to move out to areas with more land as this work from home thing becomes more of a trend. So it seems like flats haven't really gained too much in price, but houses have therefore been pushed up as more people are moving towards them. But it also means the likes of London, house prices had been pretty stagnant for most of the year, and the likes of other locations with more space had been more desirable, pushing those prices up. And then as to the economy, we've struggled quite a bit as we're heavily reliant on services, and therefore in the short term or in the short to medium term where we're in lockdown and can't use these services, it's likely GDP is going to drop, and it did. However, what I think will happen is once we reopen the economy, once the majority of the population is vaccinated, we can go out and that money saved whilst in lockdown will be used and spent. That spending of the money will therefore re-stimulate the economy and we'll probably have quite a strong GDP boost in that short to medium term period as people are spending their final bits of cash. If you're interested in why trading 212 suspended me, then click the card at the top right of the video. Thank you for watching. I'm Ozbourne Foreman. Have a great weekend.